Well, let's take stock of what's going on when it comes to the macros as well. You've got the currency, which continues to languish at all-time lows. You've got the global economic slowdown fears weighing, and the curbs in China on account of the COVID, which is also, adding to the slowdown concerns. To discuss this and more, we're joined by Bhaskar Panda. He's the Senior Regional Head Treasury Advisory at HDFC Bank, as well as Radhika Rao, Senior Economist, Executive Director, DBS Bank. Thank you so much for taking time out. Radhika, going to begin with you. A large factor in what we're seeing with the currency play out is the kind of move that we're witnessing in the US dollar. Given the fact that it just seems to be the start of the rate hike cycle, does this pose a considerable risk going forward, especially for India?
Hi, good morning. Certainly, what you did see in the first quarter of the year, of the calendar year, was that the dollar index had begun to move up, right? But that movement was much more driven by the dollar strength versus, G3 currencies, particularly the euro. So euro was languishing, and you had seen the dollar index move up. What you're seeing more currently is the dollar index vis-a-vis EM Asia, which is moving up. So essentially, the Asian currencies that were quite stable in the first half of the year, first quarter of the year, also thanks to yuan, the Chinese yuan that was also incredibly stable, that had kind of provided an anchor. But that anchor is now losing force. So that's why you've seen that as the yuan has weakened, many of the Asian currencies have also joined the fray. So in that sense, dollar index EM Asia, that's correcting, and that is catching up with where the broader dollar index is. So yes, I think this correction to us is a catch-up move, and it is just begun, like you rightly mentioned. And as markets have, priced in U.S. Fed hikes, of course, there is also worry that it could lead to a slowdown. But I think incoming data seems to suggest that the U.S. economy can still take the kind of hikes that the Fed is projecting, to correct the kind of inflation that there is. And that's why we think the dollar index per se has some tailwind. And that also means by extension that EM Asian currencies are likely to also depreciate. So I think what you've seen in the rupee is perhaps a reflection of that as well. Of course, for us, I think there is also the commodity prices that turns out to be an additional, headwind because of oil as well as the non-oil commodities, where which we import, and those prices have gone up a lot. So you've seen the rupee adjust accordingly as well. So yes, to answer your question, I think this is kind of a catch-up move for the Asian bloc per se after a very stable first quarter of the year.
Oil price fluctuations have also been very, very sharp. Where is it that you see oil prices going forward? Because that has a bearing on just about everything. It's like a domino effect, Radhika.
That's very true. Oil prices, obviously, the entire path is very uncertain. So, what our oil analysts have done is that they've taken a base case and a bear case. A bear case to mean that oil prices could be even higher. So, in our own calculations, we have taken it to be present path at about 9,500. If this geopolitical risks go on, it could be even higher. But instead of taking a direct call on where oil prices could be, I think we should watch out for two scenarios. Number one, the geopolitical tensions get worse, in which case you could have a higher oil price. And on the other point, what you can see is that growth in general, the growth slowdown concerns have also caught up, particularly because China is still pursuing the zero COVID strategy, and you've also got the underlying concern that Fed hiking aggressively could also lead to growth slowdown fears. So I would think that there would be a two-way force on commodity prices, but for most of the commodity importers, even if the prices remain where they are, I think there is reason to be concerned. And talking about the fallout on India per se, you see the current account as well as the balance of payments dynamics have changed or will change this year as compared to the past 2 3 years, right? The current account deficit has been very much under control. The balance of payments was in net surplus, so that was providing a very strong cushion to the currency. Now, when we go into this year where global monetary conditions are tightening, what you do see is a reversal. You see current account deficit that's going to be wider, and you're also seeing slowing portfolio flows. So in that kind of an environment, you essentially would see the currency being like an adjustment mechanism.
Right,
And I think that
sure.
is what is happening at this point. So that's why I would think that the central bank's focus will be on keeping it more gradual
Yeah.
and non-disruptive instead
Sure,
of a
sure.
one-sided path.
Bhaskar Panda, if I could get you in now, what is the new normal post-COVID? The range for the rupee against the dollar, where is it that you see the RBI is going to find comfort? Is it going to be 78, 80 kind of a range?
See, after we had broken the last high we had seen, it's very difficult to predict. But if we go technically, it might you go towards 79, 79, 20 kind of thing. So my view is that probably it will remain between, in the broad range of 76.50 to 79 in the next 3 months or so. I don't see it going beyond 79 for the time being, and probably it will continue to, consolidate after it has crossed the new high. It's not going to see kind of 80 or 81 that people are talking about in the market. I don't agree to this.
Shah, good morning. This is Nayantara. Now, the buzz on Mint Street has been that even yesterday, when you saw the rupee depreciate to the new low that it did, the RBI did intervene. I wanted to ask you, which camp do you fall in? Should the RBI be using these forex reserves, its ammunition, to protect the rupee?
See, if you look at the behavior of RBI in last many years, they have always come in as and when there is huge volatility in the market. They don't target any specific level in dollar rupee. I have not seen them doing that. Therefore, if the volatility is high, if they see there is a risk of, runaway depreciation, probably they will come in. Otherwise, they will just, look at the market, and then they will do whatever they want to do.
Radhika Rao, what about you? You know, there were reports out there that first up that the RBI did intervene. So my follow-up question with you, do you think the RBI should continue to do that? Because right now it looks like we are in free fall territory, just seeing what's happening with currency markets worldwide.
Certainly, I think I would agree with Mr. Panda's observations as well. I think in the past and currently as well, I don't think the central bank is necessarily protecting any particular levels or values. I think what we should see is, what has been the kind of bias that they've had for the past few years. During times of inflows, the central bank has tended to, prefer a stable rupee to a stronger rupee, thus effectively absorbing most of the flows, especially because most of them have been capital flows, particularly into the equity markets in the past, year and a half. So when they have, even when there's pockets of strength, the rupee has not necessarily strengthened, and I think it's kind of a war chest that has been built. And that is being put to use now. So that is not necessarily a wrong thing to do. And I think even though reserves have fallen below 600 billion, I wouldn't call that a big source of concern, because even at current stock, FX reserve stock, it's actually faring quite well if you were to compare with any of the external vulnerabilities ratios, right? Imports coverage, the IMF metrics, all of that is still quite sufficient. So I would think the bias would be of the central bank to keep it, adjusting naturally, gradually, non-disruptively, and but in sync with the region. So you don't want a rupee that's stronger vis-a-vis the trading partners. So even on real effective exchange rate basis, rupee is actually stronger still. This is its trading partner. So I would think that period of adjustment will continue. But the main thrust would be to keep it non-disruptive and not allow for a one-way, fall, which I think kind of seems to be the preference as well, as news emerges that they were in yesterday to protect some of the key levels.
Uh, A final question, Radhika, because we're running out of time. There are reports suggesting that New Delhi North Block would like to see the RBI intervene with open market operations, or with, as far as the borrowing program also goes, given what's happening in the bond markets and the kind of bond yields are we seeing. Is that something that all of you on Mint Street would want?
I think the central bank has made it quite clear in the past that the bond markets, bond yield movements are a public good. That all participants should act in good faith, and they continue to emphasize that fact. But what is happening in the bond markets at this point, and the yields up move, is a function of a few things. It's a function of what's happening globally. We've seen U.S. yields, rally very sharply or this year. And locally, we have seen a bond issuance calendar which is quite heavy. You're going to have record, if the gross issuance holds, it's going to be a record high. So net, what does that mean is that these are factors that are kind of outside the central bank's control. But nonetheless, I think markets do anticipate. Of course, the reports suggesting that the central bank would have been asked to do open market operations. I think that aside, the markets in general have been expecting them to step in and perhaps do some open market operations to slow the pace of rise in the 10-year yields. And also, additionally, we have to see which other pockets of demand are available. Of course, there's commercial banks, but the global bond index inclusion also seems to have been delayed a bit. So to make up to kind of stabilize yields, I would think the central bank might step in, but I don't think there'll be an outright bond purchase program like was in the case in last 2 years or last year, by way of the GSAP, because the environment doesn't necessarily call for that. Because broadly, again, globally,
Right.
balance sheets are being shrunk rather than being expanded.
That's right. We've already started to see the dial down taking place in the US, haven't we? And that's why the markets are reacting the way they are. I would like to thank both our guests for joining us live today on this edition of The Market. We can see what's happening with the US dollar index and the rupee being in the free fall. Stay tuned to ET Now for all of those updates.